When people saw gold and silver collapse in just 90 minutes, the immediate reaction was panic, confusion, and disbelief. A lot of voices rushed in with simple explanations: profit-taking, fear, investors losing confidence, but none of those explanations survive even a basic look under the hood. What happened in that short window was not normal selling, not long-term investors changing their minds, and certainly not millions of people suddenly deciding precious metals were worthless. What happened was mechanical, fast, and engineered by the structure of modern financial markets themselves. To understand this, you have to separate metal from markets. Gold and silver are traded today mostly as numbers on screens, not as bars being physically handed over. The vast majority of daily volume comes from futures contracts, options, swaps, and ETFs. Paper claims on metal, not metal itself. In that 90-minute window, a massive wave of futures contracts hit the market almost simultaneously. These weren't grandma selling her coins or central banks dumping reserves. These were leveraged paper positions being fired into a thin trading environment where liquidity simply couldn't absorb the shock. Timing matters here. This sell-off didn't happen during peak global trading hours. It hit during a period when fewer buyers were active, meaning the order book was shallow. When large sell orders hit a shallow market, prices don't drift down, they gap down. Algorithms detect the movement, trigger automatic sell programs, and suddenly the move feeds on itself. It becomes a cascade, not a decision. The market isn't thinking, it's reacting. Once prices start falling rapidly, margin calls kick in. Traders using leverage are forced to either add cash or liquidate positions. Many can't add cash fast enough, so their positions are automatically sold at market prices, no matter how bad those prices are. That selling pushes prices lower still, triggering more margin calls, more forced liquidations, and more algorithmic selling. Within minutes, what started as a concentrated paper dump turns into a full-blown avalanche. This is why the number sounds so shocking. $1.7 trillion wiped out doesn't mean that amount of physical gold and silver vanished from the world. It means the paper valuation of positions tied to those prices collapsed. That distinction is critical. The system marks everything to the last traded price, even if that price was set during chaos. A few aggressive orders in the futures market can rewrite global valuations instantly, and that's exactly what happened. Another thing to understand is intent versus effect. Whether this was a deliberate attempt to smash prices or simply a structural failure doesn't even change the conclusion. The system allows this to happen. When price discovery is dominated by leveraged contracts that can be created in unlimited quantities, real supply and demand get drowned out. You don't need physical metal to push prices down. You just need paper and speed is everything. Humans didn't drive this crash minute by minute. Machines did. High-frequency trading systems react in microseconds. They don't ask why, they just follow momentum, volatility triggers, and risk thresholds. Once those systems flipped into sell mode, the move became self-reinforcing. By the time human traders could even process what was happening, most of the damage was already done. What makes this even more important is what happened during those 90 minutes. There was no announcement of massive new gold supply, no sudden discovery that silver demand had evaporated, no central bank statement declaring precious metals obsolete. The real-world fundamentals did not change, only the paper price did. That's not a free market expressing collective wisdom. That's a highly leveraged system revealing its fragility. This kind of event also tells you something uncomfortable about confidence. Not confidence in gold or silver, but confidence in financial plumbing. Markets are sold to the public as deep, liquid, and resilient. Yet here we saw a globally critical asset class violently repriced in less time than it takes to watch a coffee brew. That doesn't signal stability. It signals how quickly confidence can be shaken when leverage and automation dominate. Some will argue this was a one-off, a freak event. History says otherwise. Similar crashes have occurred before, always fast, always blamed on vague explanations, and always followed by quiet accumulation from those who understand the mechanics. These events don't remove value, they transfer it. Weak hands are shaken out under stress, while stronger players step in once the forced selling exhausts itself. So when you look back at that 90-minute window, don't see it as a verdict on gold and silver. See it as a stress test, one that exposed how prices can be pushed far from reality when paper claims outweigh physical truth. The metal didn't fail, the mechanism did. After seeing how that crash unfolded, the next question almost asks itself. If prices collapsed so violently, why doesn't it feel that way in the real world? Why at the same time screens were flashing red, were dealers talking about tight supply, rising premiums, and delays? This is where the gap between paper markets and physical reality becomes impossible to ignore, because what happened in those 90 minutes makes sense only if you understand that price and demand are no longer the same thing. In theory, prices are supposed to reflect supply and demand. If demand falls, prices fall. If supply tightens, prices rise. But in the gold and silver markets, that relationship has been distorted. The price you see quoted globally is discovered not where metal is exchanged hand to hand, but where contracts are traded in massive volumes that can exceed real-world supply many times over. Futures markets don't require the seller to own the metal, and most contracts are never settled with delivery. They're closed, rolled, or offset long before any bar changes hands. So when prices collapsed, what really collapsed was confidence in paper positioning, not demand for metal itself. Physical buyers didn't suddenly disappear. In many cases, they stepped in more aggressively. When prices drop sharply, long-term buyers don't panic, they evaluate value. And what they saw was paper price weakness disconnected from physical availability. That's why premiums often move in the opposite direction of spot prices. The lower the quoted price goes, the more strained physical supply can become. This contradiction confuses people because they've been trained to believe that the number on the screen is reality. But ask anyone who tried to source large quantities of physical metal during sharp sell-offs, and you hear a different story. Inventory dries up. Delivery times stretch. Dealers adjust premiums not out of greed, but because replacement risk increases. They know that if demand spikes while supply chains tighten, they may not be able to restock at the same price. This is especially true for silver. Silver isn't just a monetary metal, it's an industrial one. It's consumed in electronics, solar panels, medical equipment, and emerging technologies. Once it's used, much of it isn't economically recoverable. That means physical supply doesn't respond quickly to price changes. You can't just flip a switch and produce more silver because futures contracts were sold aggressively in a 90-minute window. Gold tells a similar story on a different scale. Central banks around the world have been accumulating gold steadily, not trading it minute by minute. They don't chase paper price moves. They care about reserves, currency risk, and long-term stability. A sudden paper-driven price collapse doesn't change their strategic calculus. If anything, it improves their buying conditions. This is where the illusion of abundance becomes dangerous. Paper markets create the impression that metal is plentiful because contracts trade endlessly. But physical metal is finite, slow-moving, and subject to real constraints. When confidence in paper systems wobbles, whether due to volatility, counterparty risk, or delivery stress, attention shifts back to what can actually be held. That's when the disconnect becomes visible. Another layer to this is exchange-traded products. ETFs give investors exposure to price, but not necessarily to possession. During crashes, these vehicles can experience outflows or structural stress, even as physical demand rises elsewhere. So you end up with a bizarre situation where investment products linked to metal are being sold while real metal is being quietly accumulated. Both things can happen at the same time because they serve different purposes and different players. And this isn't speculation, it's a pattern. Repeatedly, during sharp price drops, we see reports of coin shortages, higher premiums, and increased interest from buyers who think in years, not minutes. Price weakness doesn't scare them away, it validates their thesis that the market is being driven by forces unrelated to fundamental value. What this reveals is uncomfortable but important. Price discovery has been outsourced to a system that prioritizes liquidity and leverage over truth. That doesn't mean prices are fake, it means they're fragile. They can move violently without reflecting what's happening underneath. And when that happens, relying solely on price to understand reality becomes a mistake. So when someone says gold and silver crashed, the right response is to ask, where? On a chart, yes. In vaults, refineries, and supply chains, not so much. The metal didn't suddenly lose its role or relevance. What changed was the paper narrative around it. And the more often this gap appears, the more it raises a deeper question about trust. Trust in markets, trust in price signals, and trust in systems built on leverage and speed. When prices and reality drift apart long enough, they don't quietly realign, they snap back. So now the question becomes unavoidable. What does all of this actually mean going forward? Was this crash a warning sign, or was it a setup? And the answer depends entirely on whether you understand how moments like this have functioned throughout history. Because violent, short-duration sell-offs like this are not random accidents. They tend to appear at very specific points, usually when stress in the broader system is rising and confidence is more fragile than people are willing to admit. Markets don't move purely on logic, they move on positioning, and before the crash, positioning in gold and silver had become crowded. Too many traders were leaning the same way, using leverage, expecting stability. When that happens, The market doesn't need bad news to break, it just needs a trigger. Once prices move far enough, the structure does the rest. Forced selling takes over, weak hands are flushed out, and value shifts rapidly from those who needed calm to those who can tolerate chaos. This is where people misunderstand crashes like this. They assume destruction when in reality it's redistribution. Value doesn't disappear, it changes ownership. The players who are overexposed, undercapitalized, or emotionally invested get shaken out. Meanwhile, institutions, long-term allocators, and entities with patience step in quietly after the dust settles. They don't chase price, they wait for stress. And stress just announced itself loudly. Think about the timing. This didn't happen in isolation. Governments are carrying record debt. Interest rates have already done damage to banking balance sheets. Currency confidence is being tested not just in one country, but globally. When systems are stable, markets don't behave like this. When they're fragile, small shocks cause outsized reactions. That's what this felt like. Not a verdict on metals, but a reflection of tension underneath the surface. Historically, major policy shifts don't happen when everything looks calm. They happen after volatility exposes cracks. Central banks don't admit pressure until markets force their hand. And precious metals have always been sensitive to that transition period. Before easing cycles, before currency resets, before confidence breaks, metals tend to experience violent shakeouts that convince the public the trade is over. That's usually when it's just getting started. This is also why the speed matters. A slow decline invites debate. A sudden collapse creates fear. Fear changes behavior. People who are comfortable holding positions start questioning themselves. Media narratives flip instantly. What was bullish last week becomes dead money overnight. That psychological swing is powerful and useful. It clears the board. At the same time, the players who actually need gold and silver aren't reacting emotionally. Central banks don't hold gold for quarterly performance. Industries don't use silver based on sentiment. They respond to long-term risk and physical necessity. A paper crash doesn't remove those needs. If anything, it highlights why price stability can't be taken for granted. So is this a warning? Yes, but not the one most people think. It's not a warning that gold and silver are broken. It's a warning that the system used to price them is under strain. When leverage, automation, and confidence collide, you get moments like this. And those moments tend to cluster near turning points, not endings. The other way to see this is as a wealth transfer moment. These events reward preparation, not prediction. No one times the exact minute of a crash, but those who understand structure recognize opportunity when forced selling creates distortions. That doesn't mean prices immediately reverse. Sometimes markets need time to rebuild trust, but the long-term implications often run opposite to the short-term emotion. And that's the uncomfortable truth. The more violent the shakeout, the more meaningful the signal. Calm markets don't reset behavior. Crashes do. They expose who was speculating and who was hedging, who needed leverage and who didn't, who believed in the asset and who was just riding momentum. So going forward, this moment will be remembered not for the loss numbers flashed on screens, but for what it revealed. It showed how quickly paper value can evaporate. It showed how disconnected price can become from physical reality. And it showed that beneath the noise, the reasons people turn to gold and silver haven't gone away. They become more obvious.